Ladies and gentlemen, welcome to Kohler Group's Expansion into China webinar series. This is part 5 of 10 webinar sessions we will be holding over the next 2 weeks in aiding foreign investors with their market entry and expansion within the Chinese territory. I am pleased to have Mr. Stephen Carey, Managing Director at Quantera Global, presenting on the topic of the evolving China transfer pricing landscape. The Chinese tax authorities have been at the forefront of the global tax debate underway over the last few years. This was reflected in the release of Bulletin 42 in 2015, imposing significant transfer pricing compliance obligations on companies doing business in China. This webinar session presents an overview of Bulletin 42 and what you need to know, with a focus on cost-effective documentation for companies of all sizes, as well as the opportunity for optimizing tax outcomes, cash flow management through transfer pricing planning. Before we begin today's presentation, I would just like to make sure that we're not having any technical difficulties currently. If all attendees could click on the hand button within the control panel, that will allow me to know that you can hear me. If I am having any technical difficulties on my side, or if Stephen is having any technical difficulties on his side, please do stay on the line. Usually the sound system will come back in just a few short seconds, potentially up to a minute. If on your end you are having audio difficulties, please switch from your mic and speakers to the telephone landline in order to be able to get back into the chat room. Now, as is typical with any of our webinars, we do like to have an interactive Q&A session at the end. Please don't be shy. Insert your questions, your comments into the questions section of the control panel. For those of you that are new to Kohler Group, allow me to introduce who we are. Kohler Group is a CSC company. We provide a wide range of market entry as well as outsourcing solutions to companies that are entering and expanding within 3 jurisdictions in Asia: Hong Kong, Singapore, and China. We have 10 offices throughout the 3 jurisdictions with just over 120 professionals spread throughout. One of our unique advantages is that we do speak a multitude of languages internally, enabling us to communicate with our clients in their own mother tongue. A little bit about myself. My name is Christina Kohler-Kalucha. I'm going to be the moderator for today's session. I've been working with Kohler Group since 2003 when I moved to Shanghai to open our first China office. Since then, we've expanded to having 8 offices in the Chinese territory. I've been helping clients with their market entry, expansion within China, and in some cases also the exit from the Chinese market. In addition, as of late, I've been helping clients to expand within the ASEAN region as well. I author a number of resources together with my colleagues in the company. We publish these on our websites and through other channels. We do release these through our e-newsletters, which are sent out on a weekly basis. And if you're interested in subscribing to our e-newsletter, it can be easily done so on our homepage by inserting your email address into the section called ChinaInvest.biz Information Series. Now, without further ado, I am going to give the microphone to Stephen so he can begin today's presentation. Stephen?
Thank you very much, Christina, and welcome everybody. Thanks for dialing in today. Hope you'll find this session interesting and stimulating in terms of your investments into China and expansion within China. So just the next slide, thanks, Christina. So just very brief introduction. So I'm Stephen Carey, as Christina mentioned, with a firm called Quantera Global. We provide transfer pricing services. We are in around 20 locations globally, including 10 or 11 in Asia. And we've been in the China market since 2006. As I mentioned, we focus on transfer pricing. So we define our service offering in terms of design, document, defend. Document is obviously the compliance aspect of transfer pricing, doing what you need to do to satisfy the tax authorities in your annual compliance obligations, but we really try to focus more on the design, so getting the right transfer pricing system in place such that it then becomes easier to document. And the last part of that service offering is defend, which is audits, etc., with the tax authorities. Now, if you have designed the right system and documented it correctly, then hopefully you don't then need to defend it later on. That's certainly the goal. So you can find more about us on our website, contrarioglobal.com. Next slide, thanks, Christina. So I'll get straight into the core of the presentation. I'm sort of working on the assumption that people know what transfer pricing is all about, but just in case some people have come to this on a more speculative basis, transfer pricing is the way you transact within a group. So the way you price your sale of goods and services, or interest rates, or management fees or royalties, etc., within your group. Why is it important? It's important because it determines the amount of profit you declare in each jurisdiction, and therefore the amount of tax you pay in each jurisdiction. So you can appreciate from a tax authority perspective, it's quite a critical thing. So just to set the scene a little bit, as you would know, there's been a little bit of pressure on the Chinese economy in terms of economic growth, which is putting pressure on tax collection. There's efforts to control capital outflows, which has been the case for many years in China, but has been an even greater focus in recent years, or the last 12 months or so, to try to stop a rapid depreciation of the exchange rate. Which means that when you go to the tax bureau to try to pay a royalty or pay a service fee, you get quite a lot of questions and quite a lot of pressure to try to avoid that capital outflow. On the other side of the coin, MNCs in China are feeling pressure from increases in the cost of labour, rent, etc. And dealing with transfer pricing and tax compliance generally is just another thing that they need to deal with, and a challenge they need to face and need to weigh up in terms of whether they want to be in China or be somewhere else. The other bigger picture thing that's happening is something called BEPS. Now, for those that aren't familiar, BEPS is base erosion and profit shifting, which is a measure from the OECD, we focus at the OECD level, to try to address this view, a perception or a reality that multinationals in general are seeking to avoid tax and not pay their fair share. And most of you would know there's some pretty aggressive structures in place that MNCs use to try to avoid paying tax. Now, there's always a very fine line, as you know, between effective tax planning and tax avoidance. And by thinking about transfer pricing, you're really putting the substance first and then trying to manage that fine line, if you like. So the other thing I'll just mention is that there's been some pressure. There was a recent issue came up in Suzhou in relation to Seagate. Seagate was closing its operations in Suzhou, or at least one of its plants in Suzhou, and there was a bit of a backlash from the public there, because there was a view that this was because of the tough stance that the tax bureau and tax authorities had taken on the company's transfer pricing position. So it's really starting to filter into the public domain in terms of the way the Chinese authorities are looking at transfer pricing and the way the companies are reacting. Now, this was denied by the tax bureau and also by the company itself, so it's probably just a perception, but nonetheless perceptions are quite important. Next slide, thanks, Christina. So what I would like to do now with that background is just to give you a sense of what's happening on documentation. Now, to clarify, transfer pricing documentation is not an invoice. It's not a receipt. It's not a legal contract. Although these are obviously very good supporting documents to explain and to back up your transfer pricing system. Transfer pricing documentation itself is something that's defined fairly clearly by the OECD and by tax authorities to mean a particular type of document that's prepared in accordance with the guidelines. And so essentially it consists of a summary of the business, summary of the industry that you operate in, and then a choice of a transfer pricing methodology, and then a benchmarking study to back that up. So it's something that tax authorities require companies to produce to support that their transfer pricing is indeed arm's length. Now, in most countries, fortunately, there is a threshold which is applied. So if you're a startup or your transactions are very small for whatever reason, then you may not need transfer pricing documentation. Now, those thresholds can be set very, very low. In some countries, it's less than $1 million of transactions would trigger the need for transfer pricing documentation, which seems quite excessive. China is a little bit higher, which is good, which I'll discuss in the next couple of slides. So it's not that everyone needs to prepare a full documentation package, but certainly every company needs to think about transfer pricing. And the reason in particular in China that it's important, if you're a startup, is that as your business, which can be very hard to extract if you don't have the right transfer pricing model in place up front. So that's why we believe that transfer pricing planning and transfer pricing documentation is important. Now, there's something called three-tier documentation, which I'll talk about in a second. But the other part of the equation is disclosure forms that go with the tax return. And you need to fill those in if you have related party transactions, regardless of the size. And these are a key risk assessment tool that the tax authorities are using. So effective date is 1 January 2016 for these new documentation rules. There have been documentation rules in place in China since 2009, but the changes are taking effect from the 2016 year, which means that they're due in the next couple of months. The tax authority are getting quite sophisticated. They're using analysis, big data type analysis of the disclosures that you make and the documentation that you prepare to identify key targets for audits and for investigations. So the goal is obviously to not be one of the low-hanging fruits in terms of transfer pricing risk, to try to avoid that scrutiny. Next slide, thanks, Christina. So I will now just, with that background on documentation, I'll just talk a little bit about BEPS, because that really sets the framework then for the Chinese rules. So the BEPS requirements, particularly, sorry, just to give some context here, BEPS is 15 action points. Transfer pricing is primarily action points 8 and 13. So 13 is about documentation. Now, there is a view which is quite correct that, in my opinion, that transfer pricing documentation can be a pretty heavy compliance burden. And there was some hope that through this BEPS process that the OECD will try to simplify things, but unfortunately they went in the complete opposite direction, probably under pressure from tax authorities globally, in terms of the documentation obligation that companies are faced with. If you look at the bottom left box there, the local file, that was what was typically the traditional transfer pricing documentation. We prepare it in accordance with the local requirements and focus particularly on the local business. They now take a broader view, and so you need the local file if you're above a certain level of transaction, which I'll discuss. If you have an even bigger group, then you need to have the master file as well, which is really focused on the group's global operations. And then there's this thing called CBC reporting, which is country-by-country reporting, which is for very large companies to report on what they're doing in every jurisdiction in the world. Now, the reason why they've gone down this path, of the master file and CBC reporting, is that it's fairly, it's not necessarily difficult to support your transfer pricing position and your profitability on a local level, because the tax authority didn't really have full transparency on what was happening in the entire value chain. So you may well be making a 5% profit margin on your Chinese operations, which may look okay in isolation, but then when they take a step back through the master file or through CBC reporting, and they can now see that actually you're making a 30% margin in your BVI parent company with no substance, no people there, then that's where the red flags get raised. So it's really about understanding the entire value chain, and it's really making it very, very difficult these days for those aggressive tax planning structures to be in place. Now, this is not to say that it's not perfectly valid having a BVI company or a Cayman Islands or other company in what may be considered a tax haven. It's just that if you're seen to be leaving profits there that aren't backed up by the economic substance, then you will run into trouble. one example might be in the case of China would be where often you might try paying a royalty from your Chinese subsidiary to a BVI company, which may be the owner, which may be the legal owner of the IP of that business. Now, typically that may be okay if the royalty looks within, a reasonable range, say up to 5% or so, then that may have been okay from a China perspective. But increasingly, they're saying, well, what is the licensor doing in this case to justify earning that royalty? But I'll talk about that in the next few slides or a bit later on. So that's the framework for documentation rules going forward, which, as I said, has now been applied in China through Bulletin 42. So next slide, thanks, Christina. Okay, so Public Notice 42, or Bulletin 42, depending on how you translate the Chinese, is all about documentation requirements, as I mentioned, based on BEPS. So Circular 2 was the original transfer pricing rules, and that is still in place, but the documentation section of those rules has now been replaced by Public Notice 42. Now, there were 9 forms that you needed to complete with your tax return. And so this is separate from the documentation. This is a tax return disclosure requirement. There were 9 forms which you needed to complete, which was a relatively straightforward exercise to disclose what your transactions were, what the methodology is used to support them, whether you have documentation in place, etc., etc. But now that's been replaced by a further 5 forms, plus also the country-by-country reporting forms, which, as I mentioned, are only applicable for very large businesses. So what you are now required to declare is, in those forms, is detail on the related party transactions, including a segmentation of your financial results. So if, for example, you're selling to within the China domestic market to third parties, and you're also selling to your related party overseas, then they'll be able to see what margin you're making on each of those legs of the transaction, and then it becomes more difficult to, if your margin on your related party transaction is a lot lower than your third party transaction, then questions will certainly be raised based on that. Now, there's always some very valid reasons why that may be the case, but that's why it's important to think about it and to have documentation in place to support why that may be the situation. But certainly, at face value, that does appear to be a risk factor for the tax authorities. Okay, next slide. Thanks, Christina. So I don't want to get too bogged down in the details of definitions, etc., etc. You can read that in your own time. But essentially, Circular 2, as I mentioned, was focused on the local file. Now, Public Notice 42 talks about 3 separate types of documentation with master file, local file, and special issue file, as well as the CBC reporting, which I'll go on to in a second. When you may be exempt if you have only domestic transactions, which is quite welcome. Some countries don't go down that path, and they still require you to prepare documentation even when you have only domestic transactions within your group, but the Chinese authorities are a bit more sensible in that they don't want to focus on that because there's no obvious tax loss to the Chinese economy through domestic transactions. So that's how they would look at it. If you have an APA, which is an advanced pricing agreement, then you don't need to have documentation, but that's again a fairly limited proportion of the population that would have that. An APA is an agreement you reach with the tax authority to essentially fix a certain profit margin or price going forward. And you can negotiate these with the tax authority, but there's a fairly long backlog to go through that process, and there's not a lot that get concluded each year. In the formal sense, though, of course, you can have a discussion with your local tax bureau and try to come to some sort of agreement separately to that. So they were due on the 31st of May. That's been extended slightly. The local file is due on the 30th of June, so you've got an extra month this year. And the master file is due by the end of the year. So that's on the basis that you need information from the group, from other group entities to prepare the master file, therefore they give you more time. Now, the thing is, you don't need to submit the documentation to the tax authority with your tax return or anything like that. It's just something that needs to be provided on request. And that was within 20 days previously, but now that's within 30 days, which seems to be a change that was made probably more to be in line with global standards around that point. So, but the important thing to note is that even though you've got 30 days on request to provide it, it does need to be contemporaneous documentation, which means that it needs to be in place ideally at the time of the transactions or at the very latest at the time that you're closing your accounts. So when you lodge your tax return by 31st of May, as I mentioned, you've got to complete those 22 disclosure forms, and you need to then tick whether you've got documentation or not. So if you tick yes, then that's a disclosure that you're making as the director of the company. So you would then want to be confident that you've got documentation in place at that time. One thing that we do tell our clients is that you could consider using the 30-day time lag there as a chance to translate the documentation. So if you're submitting documentation on request to the tax authority, it must be in Chinese, as you would expect. So one thing you can consider doing to make it a bit more cost effective is to prepare documentation in English only to begin with by that 30th of June deadline, and then only translate if it's requested by the tax authority. That's assuming, of course, that you do need an English version, which most of our clients do, so it can be shared within the group. Some could also just go straight to a Chinese version. Okay, next slide, thanks, Christina. Okay, so just very briefly now on the master file and local file, and what's in them. So essentially for the master file, it's if you have transactions of more than 1 billion yuan. So as you can see, it's already a pretty high threshold. What's that, around a bit over 100 million euro, so relatively high. So it certainly doesn't apply to all companies, but if the group has a master file, then you need to have that for Chinese purposes. So even if you're below the 1 billion, but the group has a master file prepared, then that needs to be available for the Chinese authorities. As I mentioned, within 12 months of the fiscal year end of the parent company. It's broadly consistent with, the Chinese requirement is broadly consistent with the OECD requirement on what should be in the master file, with just a few differences there, which I'll let you read separately, but nothing too significant there. So it's fairly straightforward if you have a group master file to then convert that to a Chinese style master file. Next slide, Christina. The next slide is probably what concerns you more typically would be the local file, which is something that you need if your transactions meet any of those thresholds mentioned there. So tangible transactions more than 200 million yuan, financial intangible of more than 100 million, or other related party transactions, which would include service fees, etc., of more than 40 million. The last point there is if you're a loss-making single-function entity. Now, this was a circular that came out a few years ago that doesn't appear to have been overridden by Bulletin 42. And what it says is that if you're acting as a single-function entity, so an example would be a contract manufacturer that's set up by a German parent company to produce in China and then to sell back to the parent company in Germany, then the view of the Chinese authorities is that you shouldn't make a loss. And the reason is that this came in around 2009, if I recall, when the world economy, as you would probably remember, was in pretty bad shape. And, the vast majority of MNCs were making losses and also attributing some of those losses to their Chinese operations. But the Chinese authorities took the view, well, actually you're just producing on orders of the German parent. You're not facing the market or trying to find customers or generate sales to third parties. Therefore, you are performing your function as a contract manufacturer. Therefore, you should still make a margin on your costs and you should still earn a profit. So that was what motivated that. And so they brought in Circular 363, which said that regardless of the size of the transaction, if you're a contract manufacturer or a single function entity like a simple distributor could qualify, or a contract R&D entity, for example, then you need to have documentation to explain why you're in losses, which essentially means to justify that you're actually not a single function entity, that you are bearing some genuine risks, and to justify that. So that rule appears, from what we understand, to still be in place. So even if you're below those thresholds that I mentioned above, if you are in losses and you think you're in that category of a single function entity, then you should think about some form of documentation to back that up. Now, it may not be full documentation, it could be something a bit more limited to explain your position, but still think about something. So as mentioned on the previous slide, or the previous couple of slides, it's due by the 30th of June, so it should be in place by the 30th of June. Now,
Stephen, can I just interrupt you because there's a question that just came in regards to the
sure.
threshold bullet points listed there. Is it just you qualify to submit the documentation if you just hit one of those, or you have to hit more than one of those?
You just have to hit one of those, unfortunately. Okay. So any one of those would qualify you for documentation.
And sorry, this is just now a question for me. If you hit one of these, are you still waiting for the tax bureaus to contact you to submit, or is it a self-assessment? You need to submit it on your own?
You are waiting for the tax bureau to request it. So there's no need to submit until requested. But I guess the only thing to emphasise there is that you will, on the tax return, you will disclose that you have documentation. So if you waited and didn't prepare it by 30th of June, or at least start that process by 30th of June, and you tick that box, then you could potentially run into problems later.
Okay.
Okay, so the content of the local file is fairly similar to standard transfer pricing documentation, but the difference is it does go into a little bit more detail on the profits across the value chain. So just to clarify this, the Chinese authorities, as you may or may not know, they're pretty aggressive or assertive on transfer pricing, and they've been eager for many years to get access to information on the value chain. Now, the OECD brought in the master file and the CBC reporting concept so that information would be available, but the Chinese authorities have also, to some extent, included the requirement to provide value chain information in the local file. And so what they're saying is that even if you're not meeting the threshold for needing the master file, then you still need to provide information on the rest of the group in the local file. So that really lowers the threshold there somewhat for that type of information. It gives the Chinese authorities access to that information. Now, there's a couple of concepts there that I think are just worth touching on in the Chinese context, and this can apply to any company, any country, sorry, but is particularly pronounced in relation to the way that the Chinese authorities look at transfer pricing, and this comes out in most of the audits that they do or most of the APAs that they negotiate. They're really focused on these two things called location savings and market premium. Now, what this is, very simply, is location savings is the view that by producing or by doing something in China, you are benefiting from the lower cost of doing business in China. Now this is obviously being eroded somewhat in the last few years in terms of the rising labour costs, etc. But there is certainly still a cost advantage of, say, producing in China versus producing in France, as an example. So the idea is that the global group will be more profitable because they're able to produce in China. And the view is then who should benefit from that greater profit that's achieved. Is it the French entity that set up the Chinese operations in that example, or is it the Chinese local entity that should benefit from that in terms of a higher profit? Now, of course, the Chinese authorities take the view that it should be the Chinese entity that should at least partly benefit from that. And there's no real certainty on which view is correct, but certainly when the Chinese authorities are looking at your profitability, they will take into account that you're benefiting, as a group from being in China. Therefore, that profit margin should look, pretty healthy compared to a typical company. Now, there's also the concept of the market premium. Now, most of you may know that there's a real demand in China. The growing middle class, etc., the world's largest population, creates a real demand for certain products, particularly luxury goods. And the price premium that you can earn on luxury goods in China can be quite significant versus other jurisdictions. So the idea is, again, who should benefit from that? Is it the global brand that might be, say, Italian, or is it the Chinese operations? And again, the Chinese are fairly aggressive on this point. So no need to, I think there's just a couple of points to bear in mind as to the way that the Chinese authorities perceive Chinese transfer pricing and the value of the Chinese operations in the global group, and something to bear in mind when setting your pricing going into China. Next slide, thanks, Christina. There is another thing called the special issues file, which I apologise for the amount of information I'm sort of giving you here and the number of different documents that you seem to be having to prepare based on this discussion. I would suggest don't be too alarmed. Certain, as I mentioned, there are other thresholds and certain things only apply to certain limited types of transactions. So try not to be too overwhelmed by it all. But there's two things called the a special issues file for cost sharing or for a fin capitalization ratio exceeding 2 to 1. So if your debt equity ratio exceeds 2 to 1, you need to justify that through the, so think about that in terms of the financing of your Chinese operations. A cost sharing agreement is a fairly limited type of agreement that there's not that many in place in China, although they are growing in popularity, where you agree to share the costs of a certain venture, to create some IP or to provide a service, and that needs to be documented separately to justify, if you're buying into that cost sharing arrangement, as a Chinese entity, then what price are you paying for that? Is that fair, etc., etc. So that's something that will probably grow in popularity in coming years. The Chinese seem to have relaxed their stance on that a little bit. You can appreciate that weighing up whether to enter into a cost-sharing agreement versus just a pure service fee type arrangement. The advantage of cost-sharing is that you don't pay withholding tax, for example, and there's other advantages, of course, as well. So that's something to consider, but Chinese have typically taken a fairly restricted view on whether you'll be eligible for that or not. But yeah, something that's growing over time. But I'll try not to dwell on those things for now too much. Next slide, thanks, Christina. Okay, I'm just a little bit conscious of the time here, so I'll just, CBC reporting is, as I mentioned, it's detailed disclosures on data within your group across the entire group. So essentially the parent company would need to disclose, and there's a prescribed format for these disclosures, what they're doing in every entity where they operate within the world. And the purpose is that the tax authorities can then see whether there's a real mismatch between, say, for example, the number of people or the amount of investment you've made into a particular jurisdiction versus the amount of profit that you're declaring there. And that can raise a red flag for further investigation. Now, this is only applicable for if you're a Chinese entity with more than 5.5 billion yuan, so, what's that, I think it's around 700 to 800 million euro, very, very large companies, or if you're a subsidiary of such a group with that size that size revenue, and you have a big entity in China with related party transactions. So, and that's exchanged through the Exchange of Information Protocol, or if the Chinese authorities can't obtain it through that process, they can request it directly from the taxpayer. So I'll go into something a bit more practical now. So next slide, thanks, Christina, just to give you a bit more of a practical flavour to all this discussion. As you may well know, if you're doing business in China, one of the key concerns is outbound payments, how to pay royalties and pay service fees to your parent or to other companies in the group. Next slide, thanks, Christina. So there is a process that's involved, which I won't go into. That's something that you should talk to Christina or to Kohler Group about, about those details. But certainly, from a transfer pricing perspective, there's a couple of things to bear in mind. It's a very challenging process. There's a lot of restrictions. We have clients that come to us and say, well, they've got this model globally where they pay a royalty of 15%, or they pay a very high service fee, or they do something along those lines, and they want the same model for China. And when you look at the economics of the transaction, it may make perfect sense. But then the reality is that the mechanism is not always aligned with that economic substance of the transaction, and so the challenge that you'll face is then going to actually make that payment with the tax bureau. They will question the amount, particularly if it's more than $50,000 US. There's a registration process that you go through with the tax bureau, as well as potentially non-tax authorities to get to lodge those agreements, and then you need to then get the payment approved. There's obviously tax implications, etc., etc. But just the transfer pricing angle to this is obviously that if you are making such a payment, that you need to demonstrate that the payment is arm's length, that it's that you can justify the benefit that's received, and that you that you're paying the fair amount of withholding tax on that payment. Now, if you're paying a service fee, in principle, if the activity is not performed in China, then there should not be withholding tax. But typically, the tax authorities like to deem that there's a permanent establishment in China and then tax that accordingly. So that's something to look out for. The one I want to focus on in particular, though, was well, two things. There's the 6 tests, which is that you need to show that that you've demonstrated that there's a benefit from paying a service, that the service is not duplicated elsewhere within the group, that you can't, for example, let's say, for example, that you're paying for an IT service from your related party in the US. You need to be able to show, on request, that you can't obtain that same service at a lower price from a third party locally in China, which is, of course, extremely difficult or impossible to support. So you do get into some challenging discussions there with the tax bureau if they do take a very strict interpretation of that. So I guess the message there is just to be conscious to document what you need to justify why you're paying the service fee. Don't call the service fee a management fee. That's a real red flag. That comes across as just an allocation of a head office type charge, which the Chinese authorities won't think is benefiting the Chinese entity. So it needs to be quite specific. But yeah, just try to think about that before bringing in a model where you're paying a service fee. The other point, and so the next slide, thanks, Christina. So the next slide talks about the process that's involved, but I will skip over that. You can read that in your own time. The next slide is the DEMPI function, which I'll just touch on because I think that's quite an important one. And this is about IP in particular. And what it says is that if you're paying a royalty, and I touched on this previously, but if you're paying a royalty, say from China to a BVI company, or in fact to any company within the group that may or may not have substance, the Chinese authorities in recent audits have been, and this is based on the OECD BEPS approach, they want to understand where the DEMPI functions are being performed. And what that means is the development, enhancement, maintenance, protection and exploitation of the IP is being performed. So if you're paying a royalty to a BVI company and there is clearly no substance in that company, then it's impossible to show that the development of the IP is being carried out there, or the enhancement or the maintenance or anything else. You can maybe support that the legal protection of that is being performed there, but beyond that, it's very hard to demonstrate. So you need to be conscious of that, particularly with royalties. It's a fairly easy thing now for the tax authority to pick up on, and we've certainly seen some recent cases where they have done that. So think about royalties in that context. Okay, just so I've covered the 6 tests already on the next slide, so we'll just skim over that. The last slide was really the next steps, which was the optimal TP model for China, which is just a summary of what we've discussed. So thanks, Christina. So just a couple of points to take away. I know I've probably overloaded you with a bit of information here. Hopefully some of it's been useful, but just a couple of takeaway points before we go to the Q&A section. The objective of preparing documentation is to do something which is defensible, obviously, with the tax authorities within China, but also outside China. Don't lose sight of the fact that transfer pricing is, there's both sides of the transaction to consider. You may well leave a large amount of profit in China because you don't want to deal with the transfer pricing risk of China, but then you'll face challenges on the other side of the transaction. So think about it from both sides. Optimize your tax position. Now, the the obvious thought is to think of transfer pricing as a compliance obligation. Try to think about it as well as an opportunity. So you know you need to achieve a certain profit margin in China to manage your transfer pricing risk, but is there a chance to optimize your tax position by thinking about it as early as possible in your business life cycle and to design the right system? And this, in particular, in the China context, means leaving an appropriate margin in China for the activities that you're performing there, but also to think about how you're going to efficiently repatriate profits and cash at a later point as your business grows. You obviously want to minimize the compliance burden and to minimize the cost associated with that. And so by carefully planning, and by that I mean think about that transfer pricing documentation in general follows a reasonably standard format with some local differences. So if you have documentation elsewhere in the group, can that be done more efficiently by thinking about it as a group rather than as one individual jurisdiction at a time, and plan that way? There'll certainly be things that you need to do from a China perspective that you can't escape from, but there may be some efficiencies to be gained by thinking about it globally or regionally. So to consider, do you need documentation? So look at the thresholds, look at your risk factors and decide if you need documentation to be in place. Service fees and royalties we've covered are quite high risk. So think about IP, how to deal with that. If you're currently paying royalties to a company without substance, I suggest your days are numbered in terms of that type of structure. So think about a better model, or think about boosting the substance that you can put into that company. Now, obviously, if it's to a BVI or a Cayman Islands company, you're not going to locate some people or substance there. But if it's, say, for example, to Singapore or to Netherlands or to Ireland, maybe there's something you can do around your substance there. The 6 tests was covered.
Stephen, can I interrupt you just on that point? Because substance has become, at least for us, a really big topic in Hong Kong and Singapore, because when you're incorporating a company in those two jurisdictions, the banks require now to see substance in order to open the accounts. When you're looking at transfer pricing, I mean, you've pinpointed the example here of IP and the importance of having substance for IP transactions. But what about for royalties and service fees? I mean, you were mentioning earlier, don't put anything down as management fees. But what about if you are specific in terms of services and royalties, and it's going to an entity that doesn't have substance? What is that? What is the perspective on that?
Yeah, that is also risky. I mean, they will look at two things. Firstly, is the Chinese entity getting a benefit from the service? And so if you can support that, well, that's a good starting point. But they can also then look at what is the service provider doing to justify earning that service fee on the service provider side. So if it's a service fee that's paid to an entity that's not actually performing those services directly, then that is an issue. If that company is acting as an intermediary and there is another service provider in the group, then that's probably okay, because they will look at the ultimate service provider, and so that could be manageable. But probably
in that scenario, you wouldn't benefit from the DTA between the intermediary and China. They might see it as a flow-through entity.
Yes, that's definitely a risk on the on that side. Yeah.
Right.
Yeah.
Yeah. Okay. No, that's clear. That was just I was just curious to see your point of view on that.
Sure. No problem. Okay, so last couple of points were just around withholding tax and treaty relief, which Christina just touched on in terms of the double tax agreements and the way that will be looked at, and also in terms of the transfer pricing in general, do not lose sight of VAT and customs duty. It's relatively easy to come up with a nice transfer pricing model that focuses on the direct tax side of the equation, but if you ignore VAT and potential VAT leakages or potential customs duty on a transaction, then that can obviously be to your peril. Now customs duty rates are generally coming down, which is encouraging. I'm not sure if that will be the case in the US though for much longer, but we'll see. Certainly, it's we've seen cases where a company has has increased the price of goods, coming from the group into a China distributor within the group, to reduce their Chinese corporate tax liability and their profit in China, which makes perfect sense from a transfer pricing side. But then that higher price of the goods coming in has increased their customs duty impact, which has wiped out the direct tax savings. So you need to really weigh up, depending on what industry you're operating in, obviously, or what your business model looks like, you need to weigh up customs duty versus corporate tax and VAT as well. Okay, that's the end of the formal presentation. So,
all right. Well, Stephen, I think a few people have been shy during this presentation, so there are actually no questions from the attendees. But
okay.
I've written down a couple of questions that I get asked about when I have initial client meetings. In the realm of when they're trying to start thinking about creating their transactions and thinking much more closely on what contracts do they need, how should the contracts be formulated, and what content should be within it. When we start off with clients, at the point of incorporation, the client is very small, obviously. I mean, the quantity of transactions and the value of transactions will definitely not meet the 3 thresholds that you mentioned in the presentation. But a question I have is, how do you persuade a client to say, you should really be thinking about transfer pricing from day one, because in 10 years' time you might, put a bullet, shoot yourself in the foot by not having thought about it, because now you have to produce the documentation, and you might also have to show some history. What have you been doing in the past to reach the threshold values? How do you persuade a client really from day one to say you should think about transfer price planning now, today? How do you say that to a client?
Sure. Yeah, no, I think that's a good question. The way that we would do it is, firstly, I think that we would, definitely recognise that very small companies are, at least initially, in terms of being picked up by the Chinese tax authorities for audits, etc., they are relatively low risk, particularly if they're in a big tax jurisdiction like Shanghai or one of the bigger cities. If they're in a smaller city, then maybe the risk will be higher because they'll appear bigger to the tax bureau. So I think it's correct to say that the risk profile is lower, but it's really a case of thinking about it from the perspective of, well, you will grow over time, so you want to have the correct model in place, and so, but in that case, we wouldn't try to sell them a local file, master file, etc., etc. What we would say is, well, really, what you need at the moment is just some comfort that your pricing is arm's length, and so that could be just a simple benchmarking study that tells you that when you set up your manufacturer in China, that they should be earning a cost plus 7% on their costs. And then you can then proceed with your business on the basis that, and the comfort that that your pricing levels are correct. So that as you grow and as the tax bureau starts to get more interested in your business, then you'll have a good basis for defending yourself. Now, over time, that benchmarking study can be updated, can be then converted into the formal documentation as and when you need it, but it's something that sort of is fairly cost effective for startup type companies to give them the comfort without going overboard in terms of documentation. The other point I'll just make is in terms of the disclosure forms that even if your transactions are very small, you still need to complete those disclosure forms where you're disclosing what your transactions are, what the methodology is you're using to price those transactions, and whether you've got documentation in place. So to be able to tick the box that at least that you've thought about transfer pricing, that you've got something in place. It's probably not full documentation, but it is something. Even if it's just a memo or something on your file to explain what the business does, what the methodology is, and what the basis that you've used to set your pricing, then that is helpful. So it's it's very much a not a one-size-fits-all type model in terms of documentation and support. So it's a case of balancing the size of the business and the risk factors versus the compliance cost, obviously. So that's, and I guess, I'm sorry, Christina, I guess the last point is just to go back again to the paying royalties and service fees. Even if you are quite small, there's still, you could still face an issue in the short term in terms of having trapped cash and potentially profits in your Chinese business that you can't get out efficiently unless you've got the right transfer pricing model in place.
Yeah, I was actually just going to hit that point. When you're a startup, you generally are scared, or when you're an SME in general, you're scared to keep money in China. I mean, most of my clients, that's their biggest fear. They become profitable. What are they going to do with that money? Can they transfer that money out of China? And I think, just as Stephen said, if you have transfer pricing policies in place, it can be a guide for you in terms of what and how you can transfer money out of China in terms of repatriation strategies. I have the tendency of seeing companies saying, oh, I'm just going to do a cost plus 5%. And that's usually the standard that most people say. It's a cost plus 5. Well, if you would do a benchmarking and all of a sudden you realize, well, on the market you could have done 10, you could have gotten, or you could have gotten 2. You have savings that you can generate there, but at least you're in alignment with what's happening on the market. And it makes you aware of what's happening on the market as well. So I think that's important. Stephen, a key point that a lot of people are concerned about when creating or doing their benchmarking is how reliable is the data that's found. I mean, China is enormous. And then another question I have is, because you mentioned this at the beginning of your presentation, you were saying, the authorities have their own data collection and I guess their own benchmark. How reliable is the authorities' data, and then how reliable is it when companies like yourself are doing the benchmarking and are collecting the data?
Sure. Okay. Thanks, Christina. It's a couple of very good questions there. The way that, just to give people that don't understand the concept of benchmarking in terms of transfer pricing, it's essentially it means that you're trying to justify the net margin, or typically the net margin. It can be the gross margin, it can be other things, but generally it's the net margin because that's the basis on which you pay tax, to justify that your net margin is correct versus companies in the same industry. So we would go into a database, we'd look at independent companies doing similar things to what you're doing, and if your profit margin is within the range of those companies, then you've got an argument that your pricing is therefore correct, and is arm's length, so it's as independent parties would behave. Now, in China, there is around, I think, 3,500 public companies that are required to prepare financial statements, obviously, and have them audited each year. There's several million private companies that don't have that same obligation, but nonetheless do sometimes prepare financial statements if they're above a certain size, and they can be available typically through, if those companies are applying for financing, for example, through a bank, then they'll obtain those accounts and they then go into a database which then forms part of a bigger database. So we can access public company data, without doubt, and also a significant amount of private company data. Now, obviously, the private company data is not always audited, so it's not as reliable. And so from the Chinese authorities' perspective, they want you to focus on Chinese public companies as the first point. But as you know, Chinese public companies are very large, consolidated groups, typically doing many, many different things within the group. So how reliable is that set of accounts compared to your Chinese subsidiaries may have 5 people performing a sales operation? Not very reliable is the answer, but and so then do you, and then you've got two choices. You can either go to public company data outside of China, so maybe Greater China plus the ASEAN region, or plus Japan and Korea, or you can look at private company data within China. The view of the Chinese authorities is changing somewhat. They're sort of more open now to that private company data, which is probably a good thing from a taxpayer perspective, because private companies tend to be less profitable than these big conglomerates that are public companies. So that's so I would say it's not, to answer Christina's question, it's not overly reliable, particularly when there's a lot of public companies in there, or even I'm sorry, when there's a lot of private companies in there, or even when there's public companies that aren't doing the same thing as what you're doing. And so it's not overly reliable, but the idea is that you take a big enough sample of companies, and then the range that you end up with, and then the median or so of that range is probably reasonably reliable, although, yeah, obviously subject to criticism there. The tax authorities, as Christina mentioned, often have their own set of comparable companies based typically on tax return disclosures, which they don't tend to share with the taxpayer. So as to how reliable they are, I think, well, we can all form our own opinions as to how reliable this secret comparable information is, but I would say not particularly. But that's, I guess that kind of emphasises the point that if you've got your own benchmarking study, then you're kind of going on the front foot in terms of your negotiation with the tax bureau, that if they produce their own set of comparable companies that is secret based on tax return data, then unless you've got something to defend yourself against that, then you've sort of got to accept their position.
So that actually leads me to one of the services you offer. I mean, you mentioned that one of the services you offer is defend. How complicated is it defending a case with the tax authorities?
Yeah, it's it can be quite complicated depending on the stage that the investigation or the audit is at. So if it's a case of the tax bureau looking at the tax return and asking questions or asking to see documentation, then it can be relatively straightforward to explain what the business model is and why the profit is as it is, to convince them that even though you're in losses for 2 years, that the business has now turned around and that you're doing okay. So it can be a relatively straightforward process, and there's always a question, about whether to bring in an advisor into that process, dealing directly with the tax bureau versus having the advisor sitting in the background, providing some coaching to the taxpayer. And there's no definite answer, and Christina may have a different view to me, but generally bringing in an advisor at least early in the process can raise a bit of a red flag. So if your representative in China is confident in dealing with the taxpayer on behalf of your company, then you should probably continue with that process with support from such as ours, or such as as Christina's firm, to support you through that process. Once it gets into a heavier audit stage, or gets escalated through the levels of the tax bureau, and they start getting very, very serious and start to coordinate at a more regional or central level on that audit, then it's probably time then to start getting very serious about documentation and supporting your position. So it's a bit of a case of sort of, I guess, easing into it fairly lightly and not giving them more information than they need up front, responding to questions and being polite, but not giving them everything in the first meeting, or then you've sort of got nothing then to defend yourself later on.
Right. And last question that just actually came in is in relation to the documentation. You said now there's a bunch more documents that need to be submitted, or forms that need to be submitted. Are these all forms that are provided by the by the district, your tax officer, or how is it obtained?
Yeah, that's a good question. Generally, if you're the forms would be completed as part of the tax return process by your tax agent within China. It can be there is a standard format for these 22 forms that go with the tax return released by the SAT. Now, as for the practicality of that, I believe that some tax bureaus have then created software that can be used then to lodge those, or it can be done on paper, obviously through your tax agent or directly. I think it does sort of vary. I mean, it's based on a standard format, and so that won't change across China, but I think the way different tax bureaus deal with it can still differ somewhat.
And is the contemporaneous documentation that has to be created, is it also a standard template that's given by the tax authorities, or do you create a tailor-made a series of documentation?
It's tailor-made. I mean, it generally follows a standard format. Under the old rules, some tax bureaus in China did release what they considered to be like a best practice format for the documentation, but that was not mandatory, and that was limited to some cities in China. Under the current rules, we haven't seen anything that's been released by the Tax Bureau in terms of a standardised approach. But if you take a look at Bulletin 40, Public Notice 42, they do go through in a bit of detail what should be in there, so it is fairly standardised in that sense.
Okay. And then, Stephen, just to summarize, I think, for the attendees that are on today or companies that will listen in later on, I mean, you mentioned when you start off your business in China, at least do a benchmarking. Know what's the market rate for the transactions that you want to do. At what point, and then you mentioned during your presentation that really you should have the files ready at the point that you hit the threshold, because then you have 30 days to do the translations into Chinese if necessary, into Chinese. At what point or at what value would you say to a company, okay, now it's time to create the documentation?
Okay.
I mean, because it's for me, it's like a three-step process. You do the benchmarking, that helps you understand your guidelines. But at what point should you really sit down? Because creating the documentation can take time.
Absolutely, yeah. No, I completely agree with that point. Okay, so firstly, as Christina mentioned, there's the benchmarking study which you should do up front, and that should be, if your business is sort of growing at a fairly steady pace and the risk seems to be reasonably well managed, then you should probably update that benchmarking every 2 or 3 years. Now, in terms of actual converting that into formal documentation, you should, at the end of each year, each calendar year or financial year, depending on what you're using, you should look at the overall size of the transactions, and then if you're above the thresholds, then definitely, obviously, you will need it. So you should prepare it at that point, and you generally start the process around April. So once your draft financial statements are ready. Now, the only point I would add there, though, is that if you're in a situation where you're having fairly robust discussions with your tax authority on the corporate tax or the other taxes that you're paying, then we've seen plenty of cases where they have requested documentation earlier than is required under the rules. We deal with a couple of clients in Weihai, and they typically ask for it around April time, which is quite unfair, but they do that sometimes. And we've seen cases as well where particularly in some of the smaller or the medium-sized cities, where they have requested documentation to be provided even when you are below the threshold. So there was a case a few cases a couple of years ago where one province decided to lower the threshold from the 200 million to 100 million RMB for transactions quite arbitrarily, which was unfair, obviously, on taxpayers, but that's the power that the local tax bureaus have. So I guess it's a case of looking at your transactions at the end of the year, making an assessment based on the thresholds and on your overall risk factor, but also being conscious of how your dialogue is going with the tax bureau and whether they're sort of starting to raise questions, etc.
Okay. Well, I think we should leave it there. We've just run over time.
Sure.
I wanna tell all the attendees, if you do have any questions, you will get a copy of the PDF of the presentation. There is Stephen's email address and phone number, so don't hesitate to contact him as well. If you would like me to make a formal introduction to Stephen or his team members, then again, don't hesitate to contact me, and I'd be happy to do that introduction. Just some last-minute admin stuff. If you've enjoyed this week's 5 webinars, then by all means do join us for next week's 5 webinars. We've got another 5 webinar sessions that are happening, and you can easily register by following the link here. And last but not least, if you are interested in subscribing to our resources, our e-newsletter that's sent out on a weekly basis, then that can be done so on our homepage. We also have a YouTube page with all the recordings, of the webinars and a LinkedIn page where we are updating daily on the webinar sessions that are occurring. So I just want to wish everyone a great weekend. Stephen, thanks a lot for your time and for presenting to everybody.
No problem. Thanks, Christina.
And
thanks, everybody.
And I wish everyone a great weekend, and I look forward to seeing some of you again next week. Thanks a lot, and goodbye.